Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. Today's guest, Ron Hera of HeraResearch.com, and he does macroeconomics and takes that macroeconomics and boils it down and looks at individual commodities and resource stocks. But, you know, he's got a great grasp of the macroeconomic picture. Hey, Ron, thanks for being on USAWatchdog.com.
Thanks for having me on.
You know, in January, you wrote a piece, which I love the title, The End of Cheap Everything. And at that point, you really didn't know about the LIBOR scandal, which is the, giant criminal activity of rate rigging, anything with an adjustable rate mortgage. And, it helped a lot of people, but it hurt anybody who was buying the bonds or, had the mortgage-backed securities or on the other end of the derivative trade. Let's talk about how the LIBOR scandal can basically continue to propel your premise that we are living in the age of the end of cheap everything.
Well, we're living in an age of rigged markets, essentially. I mean, arguably all markets are rigged at this point because when you backstop too big to fail financial institutions, that's really market rigging. And when you have central banks buying sovereign bonds from states that would otherwise be insolvent, that's market rigging. That's rigging of sovereign debt or of the bond market. When you have the Federal Reserve buying mortgage-backed securities from troubled banks, or when you have the Federal Reserve in particular buying U.S. Treasuries in the open market where those funds can flow into the stock market or outside U.S. borders into emerging markets causing price inflation, that's market rigging. So when you have support of the markets in that sense, where central banks are intervening in the bond market, even in the stock market, and backstopping the financial system, this goes beyond just central banks setting interest rates. This is market rigging.
Well, I talked to Paul Craig Roberts earlier this week, and he said, well, I'm not condoning this because Paul Craig Roberts is one of the good guys. He's a former assistant Treasury Secretary. He was responsible for monetary policy in the Reagan administration, basically one click under the Treasury Secretary. And he said, I'm not condoning this, but they basically did this to keep the financial system going under. And my retort was, so we basically have to have a fraudulent system to keep it afloat. And he says, well, yeah, and the Federal Reserve is just going to print money and pay off the lawsuits and pay people the interest they would have gotten. And doesn't that play into your theme of the end of cheap everything, which is, they're monetizing debt. They're printing money to pay off lawsuits is what they're going to do probably. For the banks, they're going to hand them money. Does that play into your theme, the end of cheap everything?
Well, absolutely it does. And in fact, that really is the ultimate question about the LIBOR. It's being called a scandal, but really it's fraud. The ultimate question is, so as these lawsuits move through the system and as various fines or penalties are applied, who really pays? These are too big to fail institutions for the most part. And so ultimately, they're going to borrow money at artificially low interest rates from central banks, or they can sell balance sheet assets for their face value when in reality the market value is less to central banks in order to get cash. And so in that sense, it's really diluting the money supply. And ultimately, it's savers and workers that will pay these fines because of the too big to fail policy.
They'll pay them in terms of increased price inflation.
Exactly, because of monetary debasement. I mean, that's what the end of cheap everything is really all about. We're in a world of too big to fail financial institutions. And what that means is that they have unlimited financial support from central banks and from governments. Of course, the governments themselves are overburdened with debts. So this is a system where the only way to really perpetuate and continue the system, the only way to guarantee too big to fail, in the face of the many risks and problems in the system, in the face of even legal challenges or crimes for that matter, the only way is to just keep handing money to these banks. They have carte blanche. There is no way to really stop them. When one of these banks, which is too big to fail, commits a crime, the CEO steps down, a new chairman is elected, or a new CEO steps forward and basically goes on a roadshow. It's a PR campaign. The newspapers call it a scandal, sweep it under the carpet. So who really pays? I mean, these institutions aren't going to be taken down by the LIBOR scandal, whereas in a free market, they would be taken down. So this is the situation. The central banks and governments will support these institutions. They ultimately will print the money to paper over the problems, and that means that the money will lose value. Savers are going to be penalized by that. Workers will be penalized by that. So ultimately, it's ordinary people, it's taxpayers who are going to foot the bill for these crimes. And there is no end in sight for this crime wave, essentially. Because as long as there's a too big to fail policy, there really isn't any way to stop it.
Isn't this kind of an ice pick chipping away at the credibility of this fractional reserve system? At some point, doesn't everybody just say, hey, whoa, it's too much fraud for me. This is the game over. I'm done. At some point, isn't this an acceleration of the collapse that it looks like we're heading for? I guess I'm putting words in your mouth, but first of all, do you think we're heading for a collapse? And second of all, does LIBOR accelerate the coming collapse, if you think that's so?
Well, LIBOR is definitely a major problem in terms of market rigging, and the reason is the scale of it. Anywhere from 350 to 550 billion worth of financial instruments, particularly interest rate swaps in particular. So this is a massive crime in effect. But to answer your question, as far as moving us towards some kind of end game or a system failure, so to speak, I think the system has failed. I think the system failed in 2008, and we're now essentially living on borrowed time.
Good point.
And as far as a final collapse of the system, I doubt that that's something that's going to happen in a sudden and catastrophic way. Arguably, that's what would have happened in 2008 if it had not been for the massive interventions that took place at that time. So in my view, we are in a space where the regular rules of economics and of really the financial system have been suspended. We're in a computer-generated dream world, so to speak, where everything is rigged, in effect. And so these institutions that should have failed didn't fail, and we're living in a world where they still should fail, but they're not failing. So how long can that go on? That becomes the question. And there's a lot of different numbers you can look at. You can look, for example, at federal debt in the United States. You can look at, for example, inflation, or you can look at the money supply, particularly the Austrian true money supply, or TMS. All of those numbers look like charts that resemble an exponential function. And for all those numbers, we're on the vertical part of the curve, so to speak. And so when people see something go straight up, of course, they say, well, you know, things that don't go straight up forever, this must end. And so on a long-term charts, that's absolutely true. When you see that you're on the vertical part of the curve, obviously that's unsustainable. But unsustainable and imminent are two different things. When you zoom in and look at it from a quarter-to-quarter view, or if you look at it even year over year and you're talking about, let's say, inflation or the money supply, those changes actually still are manageable. Are we on an unsustainable course? Yes, absolutely. It's an unsustainable course. But will it fail tomorrow? Not necessarily, no. Now, I'm not ruling out the possibility of catastrophic failure, let's say a collapse of confidence in the dollar or in treasuries, for example, particularly on an international basis. But the reality is it's not in the interest of any of the major players, and I mean sovereign states, let's say China or Japan or the UK or any of the European countries. It's not in their interest for the dollar to collapse. It's not in their interest for the U.S. Treasury market to collapse. And so they will support the dollar and the Treasury market as needed in order to prevent that collapse. That's what we've seen already happening.
But they are moving on to another system, the Chinese, Japanese,
that's
Indians,
right.
From India.
And that's exactly right. And that's a gradual process. And so I put the timeline pretty far out in terms of when is that transition to the point where the dollar is no longer a major reserve currency, and it probably always will be a reserve currency of some sort. By that I mean that what we see in the world today is that the world is fragmenting into currency-based trading blocks. They're moving away from the dollar, but it's a long, gradual process. And so what we will see, I think, is really more support of the banking system, the financial system, the treasury market, and we will also see the rest of the world, particularly Asia, moving away from the U.S. dollar. And as that progresses, the dollar will weaken. But of course, the dollar is only compared to other currencies. It is a relative scale, and it's kind of a race to the bottom against the euro. I mean, we've seen the dollar at 83, almost 84 in recent weeks, and the reason is that the euro is extremely weak at this time. But that doesn't really speak so well of the dollar. It really tells you more about central bank support for the dollar, and it tells you that the dollar is stronger than the euro.
Final question. How does the worker bees, the people who are going to pay for this LIBOR scandal, how do they protect themselves?
Well, my belief is that the only way to avoid the hazards of monetary debasement is to own hard assets. And by that, I mean things like land or precious metals, hard assets. Now, to be clear, there are inflationary forces, and that's a policy-based inflation. Basically support for the treasury market or for European sovereign debt, support for the stock market as needed. Those are inflationary measures. Government stimulus spending, that's an inflationary measure. So we have policy-based inflation. But outside of policy, we actually have deflationary forces because there's excess leverage in the financial system. There's too much debt in the economy. And that's true in Europe. It's true in the United States in particular. It's true in England as well, in Japan. So we have deflation and inflation. We have deflation in the broad economy, the real economy, so to speak, and then inflation, policy-induced inflation in the financial system and in the financial markets. So this is a very hazardous situation for investors because you run the risk of lower prices, or you run the risk of being strapped for cash where you have debts to service, or you run the risk of losing purchasing power due to inflation. So I think the only way to ultimately protect yourself is to own hard assets free and clear, assets that are outside the financial system, that are unencumbered by debt.
Ron Hera, HeraResearch.com. Thank you very much for being on USAWatchdog.com.
Thanks for having me on.